Welcome to the fourth annual edition of DoubleLine's Roundtable Prime. The new year appears to offer cyclical downturn in a landscape of secular change as the world looks to be on the threshold of global recession. Moreover, trends that for decades have driven economies, markets, monetary policy, and governance might be staging reversals. Join our six thought leaders as they analyze the macroeconomic state of play, offer market outlooks, and share their best investment ideas. Your host is Jeffrey Gundlach, CEO of asset manager DoubleLine Capital. Moderating the discussion is DoubleLine Deputy Chief Investment Officer Jeffrey Sherman. Our distinguished guests are James Bianco, President and Macro Strategist at economic consulting firm Bianco Research; Danielle DiMartino Booth, CEO of economic and financial research firm Quill Intelligence; David Rosenberg, President of economic consulting firm Rosenberg Research Associates; and joining Roundtable Prime for the first time, Charles Payne, Fox Business News anchor and host of Making Money with Charles Payne, and author of Be Smart, Act Fast, Get Rich, and Unstoppable Prosperity.
All right, everybody, welcome to the fourth annual Roundtable Prime. I'm Jeff Sherman, and I'll be your moderator today. You saw the intro, so let's just hop into it. As I look back on 2022, a lot of us are thankful to see it behind us in the rearview mirror. It was a year defined by really abysmal market performance, whether you look at equities, whether you look at fixed income. One of the lone shining stars was the dollar complex, or the dollar itself, along with the commodity complex. But other than that, there weren't a lot of things to really write home about in 2022. It was a year defined by inflation, massive central bank tightening across the globe. And so here we are today to really discuss what we see as the outlook for 2023, what is the setup, and what our distinguished panel today will elucidate us with their insights. So let's start it off. As I said, 2022 was characterized by inflation. Let's just go left to right. So what are you thinking about, Danielle, when it comes to the world of inflation in 2023, and what do you see as the path setting forward and how that dictates into the macroeconomy?
So, the Fed actually did an interesting paper recently that showed that rather than an 18-month lag, that they figured it was closer to a 12-month lag, this current cycle, in terms of when monetary tightening filters its way fully into the economy. That would put us in March of 2023 of this year. And I think what we're seeing as a result is disinflationary pressures that are multiplying left and right. We're going to see a faster throughput to falling house prices, falling rents, and that is, of course, the biggest input into core PCE. And in addition to that, and we can talk a little bit more about this, there's been a tremendous tax break for businesses. Income tax refunds were $165 billion in the last 12 months. That has filtered into tons of services inflation as people have sprung out and gone to travel and out to eat and spent a lot of it. That's going away. So the fiscal impulse in terms of its inflationary input in 2023, I think fades quickly.
Okay. Charles, what are you thinking about too on this inflationary regime?
Yeah, I think the topic's going to be a recession more so quicker than anyone's anticipating. And to me, I just find it interesting because the economic data comes out and we always talk about or hear about the headlines. For instance, the recent JOLTS report, still coming down, but not as fast as anyone thought. But look at the quits part of it. More particularly for me, I looked at transportation and warehousing jobs. 3.9% quits from 2.9% 1 month, and this is going back to November. So one of the great things about the labor force over the last couple of years has been the transition from the lowest paying jobs, leisure and retail, into other low skill jobs, but higher paying, like transportation and warehousing. So Amazon's canceling all of its contracts. They're cutting back on their plans. FedEx, everyone's doing the same thing. I think that transition is going to break really quickly. ISM number wasn't too bad. Tell you what, take a look at the ISM number, prices paid, which we want to come down. The last 9 months, the pace of the prices paid coming down has only been matched twice in history. You got to go back to 75 and the great financial crisis. I think recession is going to be huge. We're going to start to see it. You won't have to dig as deep into the details to get it. And I think early on, that's going to be one of the major factors that the market because that obviously at some point will have to be acknowledged by the Fed.
Yeah, and Jeffrey, you've talked about this in many of your webcasts and your public speeches about this natural source of gravity that everybody feels that the inflation rate will just gravitate magically back to 2%. And so have you updated your thinking about that today as we're on the cusp of a new year? Or are you still kind of in this idea of that it's either going to remain elevated or potentially overshoot meaningfully as well?
Yeah, I don't think anything's changed. This is kind of a slow-moving data series, but the inflation rate obviously surprised tremendously to the upside, getting to 9.1 on the headline CPI. And I kind of have the suspicion that the Fed wanted the inflation rate to go to 4. I don't have any hard data on that. It's just my gut. But they talk about the first 2 was the ceiling, then 2 was going to be the target, then 2 was turned into the floor, and they were having such a hard time getting above 2 that they overstayed their welcome by a lot in the midst of all that stimulus. And so it didn't go up to 4, it went up to 9.1, and that caused all of this tightening. But it's coming down, and we know it's coming down with metaphysical certitude in the next few months because of the base effect. The numbers that are rolling off are big numbers, and the ones that are coming on, there's no real reason to believe they're going to match the numbers that are rolling off. So at DoubleLine, we have a fairly simplistic, but it's a pretty good predictive inflation model. It's good for about 6 months. And we've been looking for the inflation rate to fall pretty quickly, really ever since late summer, early fall. And we think it's going down to about 4% for the May report that's going to be published in June. And then it may stabilize there, may start to go a little bit higher. But what's weird is that the CPI fixings in the market and the consensus of economists believes that actually the inflation rate is going down to 2%-ish, maybe 2.5%, by the end of next year, and then magically is just going to stop and live at that number for the next 3 years, which is completely implausible. The inflation rate does not go dead sideways for 36 months in a row. And so with the Fed still resolute on tightening and with the economy clearly slowing down and many recessionary indicators putting a recession at the doorstep here or 6 months away, I don't see any reason why the inflation rate is just going to stop with that type of downward momentum from 9.1. Let's say these economists and CPI fixings are right, 9.1 down to 2.5. There's no way it's just going to stop there with that type of momentum. It's just kind of almost a rule of physics with a pendulum. It doesn't go here and then just stop here. Yeah. So I think that the bond market has been sniffing out the idea that the inflation rate is going not only down to 4, but thanks to the Fed doing its thing and the economy weakening further, we might get a negative year-over-year CPI print sometime during 2023. And that's really kind of shocking when you think about where the mindset was about 6 months ago. And this is why, one of the reasons why the curve is so inverted, why we haven't had much market reaction at all with the most recent Fed tightenings going all the way back to May, really. So I think that we are looking at a substantially better backdrop, particularly for the bond market in 2023.
Yeah, so Jim, you've been critical of the forecasters over the past too, whether it's the earnings, that there's this natural gravitation, right? There's this anchoring bias that's out there too. What are you seeing in the market today too? And you do a lot of work on the inference from what's coming from markets as well. What are you seeing, and how are those being rationalized relative to kind of the economic forecast today?
Picking up on something that Jeff was saying, it is a metaphysical certitude that we're coming down from 9. Look, if we didn't, we were in a world of hurt if we were going to be permanently in a 9% inflation world. But really the question is, where are we going? Are we going to 4? Are we going to 2? Are we going negative? And if so, why? Maybe it's the recession that Charles was talking about that could artificially depress the inflation rate. But as you look out beyond the cyclicalness of 23, where do we settle out? And I'm in the camp that we settle out at some number that is significantly higher than 2, maybe even closer to 4. And that is what I think is where the disconnect is with the consensus view. The consensus view, as Jeff was trying to say, is it's what they saw pre-pandemic. Pre-pandemic, it was somewhere 1.5 to 2.5. And now they think that this is all about a pandemic and a reopening, and then we're going to go 1.5 to 2.5 forever and ever. Where I differ with them is I think that there's been some secular movement in the economy, global economy, U.S. economy, that's going to create higher inflation. And I've called it, the end of cheap goods because we're at peak globalization. the end of cheap labor, which is what we see now, whether it's quiet quitting or hybrid work, or workers have more say and we're getting higher inflation, and the end of cheap energy. That's mainly a European thing because their main source of energy and the biggest energy producer, when you include natural gas, is Russia, and they've effectively cut off Europe. And so all of those things can be resolved with a lot of time and effort and spending. But until then, we're at an elevated inflation world, and the consensus is showing us that they're just not ready to believe that yet. They're still thinking that we're going to go back to 2019.
Yeah. And Dave, a lot of your research you've been writing about for a while talks about the disinflation or the deflationary environment. Can you tell our listeners today how you get to that conclusion as well?
Right. Well, look, to forecast inflation. So inflation is the call it the year-over-year rate of change in the aggregate price level, and you need two curves to do that. You need to have an understanding and a forecast of what the supply curve looks like, and you have to have a view as to what the demand curve looks like. So let's look at the demand side, and GDP is aggregate demand. It's total spending in the economy. So what's interesting to me is that when you're taking a look at the trend, say the 3-year trend in real GDP leading up to COVID, it averaged just under a 2% annual rate. And then in the 3 years since COVID, and through the pandemic and through the lockdowns and through all the stimulus, and now through the reopening, and now through the Fed tightening, what has aggregate demand averaged? GDP growth has averaged in the past 3 years less than 2%. So this is not the 1970s. 1970s was booming demographics and booming aggregate demand. Aggregate demand growth is the same in the past 3 years as it was before COVID. What happened was that we got whacked with multiple supply shocks, starting with COVID. And then, of course, this time last year, we had Omicron. Then we had the Russian invasion of Ukraine. Who was calling for that? That had a major cost consequence on the global economy. And then who was calling for the fact that China, God forbid, gets 5 COVID cases and they shut down a port city of 20 million people? This was recurring over the past year. So the demand curve didn't really change net on net through all the fluctuations because of policy. What changed was supply. And I think what was already mentioned was today's ISM number. What was very important, by the way, beyond just the fact that the prices paid, went down to the lowest level since April 2020. So we've dialed all the way back to when the economy was locked down. But the vendor delay, the vendor performance, delivery delays are down to the lowest level since March of 2009, when we were frozen in the worst recession since the 1930s. So the supply side is clearly easing. Supply side is clearly easing at a time where demand growth is right now just matching the trend that we had before COVID. And we know, as Danielle mentioned, the lags from monetary policy, demand is going to be slowing. We just don't know the extent, but it's going to be slowing. And we know that the supply side is easing. Now, don't know how to respond to Jim's comments about where inflation is going in 3, 4, 5, 6, 7 years' time. Who knows what other shocks are going to come our way? But let's just say for the here and now, let's take it a year at a time for 2023. Yes, inflation is going to fall and probably fall materially. We have supply constraints easing with demand slowing down. That's basic economics 101. On top of that, to quote Milton Friedman, inflation is always and everywhere a monetary phenomenon. And we were discussing last year, the year before, the booming money supply numbers. And the money supply numbers don't have an indefinite impact, right? The lag is 12 to 24 months. It's in the rearview mirror. And I was talking about this, last night with Jeff Gundlach, that we have a situation where M2 year over year is now 0. Since 1959, that's when the data started. It's never been that weak. M1 is now contracting at a 2% annual rate. Pick your favorite money measure, it's contracting. We can make a guess as to what velocity is going to be doing, but the money supply numbers that were telling you that inflation was going to be a problem, a bigger problem than I think anybody here thought, and I think Jim got the call right on inflation. It surprised everybody. The money numbers are rolling in the other direction. Okay, and so that's where I really fall out of it, is that the supply-demand framework I'm working on is telling me that inflation is going to fall materially, and the money numbers are telling you the same thing, and they're a great leading indicator. And on top of that, we know that the lagged impact of the supercharged dollar, commodity prices have peaked. Now, maybe not peaked indefinitely, but peaked for the cycle. So the good side, the 40% of the CPI that's goods, that's looked after, okay? That is looked after for the coming year. The key is going to be services. Now, of course, now the Fed's focused on ex-shelter services, what's left there? Like, you're going to target healthcare and education. They're not even cyclical. Be that as it may, we know that we're going to have a deluge of supply of rental units on the market. We know that in real time, rental rates are coming down. And with the lag and the way it's constructed by the BLS, that's going to show through in the second half of the year in materially lower service sector inflation, bumping up against goods deflation. So I actually think that Jeff Gundlach is 100% right. I think we're going to blow through 2% to the downside, and can't really pick the month that's going to happen. I don't even know if it's necessarily going to be a this year's story, but in the next 24 months, I will go on record as saying we will see at least 1 month of a negative year-on-year print on the CPI headline.
Okay. So as you think about that setup too, as you look through, what's happened, with these policies, and you're talking about the aggregate demands, and where does the growth come from, right? I think that's the biggest challenge we all have, right? What is the stimulus effect here? Too, you talked about fiscal impulses. You're talking about a monetary supply that hasn't grown at all. We've never seen that. Like the 6-month number we were using, just because it was so precipitous to fall. Obviously, we overshot to the upside and all that money printing. Where does the growth come from? Jump ball.
I'll jump in. I cannot overemphasize enough, even though it's in a state of turmoil right now in terms of the leadership of the House of Representatives. But the lack of a fresh fiscal impulse, I don't think can be understated. The IRS has already started warning individuals that a lot of the factors that amplified 2022 income tax refunds for individuals are going to be going away this year. So a lot of households who are expecting to get the same amount of cash deposited to pay off those Christmas credit card bills that we know have been run up to kingdom come, that cash is not coming in the same form. Their rents have gone up. They're going to come back down, but their fixed living expenses right now are higher than they would otherwise be. And we have continuing claims up 31% off of their May lows. That's 7%, that 7-month delta. We've always been in recession with continuing
claims.
Off
very, very low
we came off very, very
right?
low levels. But if you look back to the history since 1967, anytime you've come, it doesn't matter what the base is. Anytime you've gone up 31% in the number of Americans collecting unemployment insurance, meaning they cannot get a new job, we have been in recession since 1967.
Yeah. But isn't growth a 4-letter word right now? I mean, isn't the idea that the Fed is trying to, they're aiming for where you're saying where all the money is, the excess savings, which we kind of talked about earlier, which I think is really what bothers me and it scares me the most is and then David pointed out, always points out some of the fallacies, and Jim Bianco, that with the data that they use to come up with this stuff or help form policy. But, I'm really concerned about the notion that, okay, households are so healthy and so robust. You hear this every single day, and you hear from Fed officials, and you've got folks like Bill Kaspari, who was the ultimate dove, not the ultimate hawk. But then you drill down and you start to say, okay, is there $1.5 trillion in so-called excess savings? And it's the goal of the Fed to drive out, because they're not going to be able to. The bottom 50% have already gone through theirs. Those are the stimmy checks. And the top 50%, particularly the top 25%, they were able to get that excess money through wages and just good old-fashioned savings. So you're not going to drive them up. So if the Fed is so fixated now on not only stopping that new 4-letter word growth, but sucking out as much from this economy, breaking it down, creating, as they say, breaking things, higher unemployment, more people not working, stop wage growth, and stop the wage spiral dead in its tracks. If they're going to do that, I just fear so much beyond markets what's going to happen to Main Street America, and I think it's going to be devastating. And to that point, they'll probably have to pivot a lot sooner than people are thinking right now.
Yeah. So
Charles brings up a great point that I have been talking about for years and years, and that's this weird truism that when consumer borrowing goes up, that's a sign of a really healthy economy. Particularly in 2022, when the borrowing is going up for food and gasoline. It's just so idiotic to say that, well, this is a great sign for the future because people are feeling so comfortable with using their credit cards more extensively. It's just absurd. They're doing it not out of choice, but out of necessity. And, and another truism is about how strong the labor market is, but it's a lagging indicator. It's always the last thing to go. And the unemployment rate is low at 3.7, but the Fed predicts that it's going to 4.6 by the end of 2023. Well, that'll be well above its 12-month moving average. And that's really the last indicator to go. When the unemployment rate goes above its 12-month moving average, it's almost a guarantee that you're in a recession. And we're 30 basis points away right now, and the Fed's forecasting that's going to happen in the months ahead. So your question was, where do you find accelerants for the economy? I can't really very easily. The housing market, of course, is simply doomed in terms of activity, with the monthly payment on the median mortgage up by over 100% since pre-pandemic. And obviously that has a lot to do with home prices going up and the interest rates, which have been coming down a little bit, so there's some relief there. But it's not in durable spending, it's not in durables buying. That was all pulled forward during the pandemic. Services have pretty much caught up to their pre-pandemic trend. So I can't find where this is supposed to come from, except if you get, I don't know, maybe a weaker dollar or something.
So as you guys think about this too, and Rosie, let's start with you on this, and let's work our way backwards this time. Where do you see the Fed going this year? I mean, Charles, you brought up Kashkari. He's out today saying 5.4, not 5.35, not 5.45, but 5.4 is where he wants to get. We keep hearing this. The Fed is committed to the inflation fighting. Talk me through, where does the Fed go this year?
Well, look, they clearly want the markets to price out those 2 rate cuts that are being discounted, say, in the swaps market.
And those are in the back half of the year.
Yeah, I think that, look, we have to make the assumption that these are bright people. They're not idiots. They know what's going on. And we're not going to find out the truth for 5 years when we get the transcripts. Because the minutes are just really almost like a policy document. They tell you what they want you to hear. You don't know what's going on behind closed doors. I'll show you what I do for fun, so you'll see what a great fun-loving guy I am. I've done this history of taking the minutes of a meeting and looking at the transcripts, and you sometimes wonder, was this the same meeting? I think that they want to do a reset of valuations in the markets. And I mean principally the stock market. But Powell can't come out and say, I want to destroy your 401k. But you got to remember when he was...
But he can say, I want job losses. Right?
Huh?
That's what he's implying. But he can say, I want job losses. That's implied from the unemployment rate.
Well, that's implied in their forecast because they already told us. I mean, the cat's out of the bag. I mean, to be debating whether or not we're going to have a recession, we just have to really debate as to whether it's starting in the first quarter, second quarter, third. It's going to be sometime this year. They let the cat out of the bag because they told us that the unemployment rate is going from 3.5 from the cycle low to 4.6. And you don't have to be the world's best historian to know in the post-World War II experience that you've never failed to have a recession when the unemployment rate is up more than a percentage point. They've told you that. And depending on what your assumptions are for the participation rate, that's going to mean roughly 2 million jobs lost, not the end of the world, except for those 2 million people. And so they're telling you, actually, that this is our forecast is going to be for a recession. And they'll maybe, will it be mild or not mild or severe? Who knows? I think that it's interesting that the same people talking about a soft landing 6 months ago are now saying, don't worry, it'll be a mild recession. But there is no correlation between the severity of the recession and the market performance. We had the mildest GDP recession of all time in 2001, and it was a mother of a bear market. And a lot of the times, it depends in the stock market. Stock market is really earnings times the multiple. And we started off this cycle with a 22 multiple. Last year was just, you said goodbye to 2022. The earnings recession hasn't even started yet, okay? Right. That was a 5-point multiple contraction because of the Fed, and 2023 will be the lagged impact of what the Fed has done on corporate earnings. So even in a mild recession, you see the thing is that profits are volatile. GDP is more stable. So you could have actually a mild GDP recession, but equity market, see, this is what they don't say. It's going to be a mild recession. But maybe it'll be a mild GDP recession, but will it be a mild profits recession? So even in the mildest GDP recessions, profits go down 20%. Equity investors aren't paying for GDP, you see. They're paying for earnings. As I digress, what about the Fed? There was a litmus test, I think, and Danielle can correct me if I'm wrong. I think it was the November meeting. It might have been the one earlier where they snuck in for the first time in the press statement that they're being mindful of the lags. The market's ripped for half an hour. Do you remember the stock market ripped? And then Powell goes to the podium and says, oh, I forgot to tell you that the terminal rate is going to be much higher than we were telling you in September. Oops, and then the market went up. So you see, that was a nice little sort of like a microcosm for what they're trying to do. Here's what I think what the Fed's trying to do, which we won't know till we get the transcripts. It's about the market. So they're trying to find every single other thing. Come on, job openings. Talk about a soft number. Job openings. It's got the grand total of 2 cycles behind it. Give me a break. Job openings to unemployment. Now in the minutes today, it's about it's about core PCE, core services ex shelter. So they're just trying to dream up ways out of the economic data to tell you we want to stay tight. But it's really, I think, about the market. And remember, when he got appointed in January 2018 and confirmed, he came out guns a-blazing, right? And I think that what Powell is trying to do, and then of course he pivoted, right? He pivoted. They're trying, in my opinion, to eradicate something called the Fed put. And when the first time they sound dovish this year, and the stock market doesn't react or goes down, that'll be the day that they'll say, okay, we're done. I think that they'll be cutting rates in the second half of the year, okay? And by the way, people talk about a pivot. The Fed never, unless you have a stock market collapse like October 87, I was born into the industry that day, they usually wait 6 months. The pivot doesn't happen like the month after. So they'll by definition be late. They were late to tighten, they'll be late to ease. And I think actually, I think the funds rate in recessions, and I know there's this whole view about secular inflation, all this stuff. I think that in the next 24 months, the funds rate's going back down to zero. I think we're going back down to the zero bound.
The JOLTS data is very strange because people talk a lot about it, yet there's no reason to believe that they're real. I mean, I'm going to start a distressed hedge fund for corporate bonds. I want to hire 1,000 20-year veterans of distressed debt. Oh, I'm paying minimum wage. Right? That's not real jobs. That's a very fabricatable number.
Oh, you whisper somebody's ear at a job fair. Oh, that's an opening. The reality is this, and maybe the best labor market expert that there is, that I know of, is David Blanchflower, who used to be at the Bank of England. I know Danielle knows him. Just did a study, which I actually tried to replicate, and we did. And there's no correlation between anything the Fed's talking about. Job openings, which only go back to 2000 and started in 2000. It started like 2 decades. No correlation with wages. Well, it's not correlated with wages. Why are you looking at it? But you see what I'm trying to say is that they have there's something different. I think that if we're all right on the stock market, I imagine that we're all varying degrees sort of bearish for the year. I got to tell you, I think you got to be reasonable. Okay, a 17 multiple right now is not reasonable. Not reasonable given where interest rates are, unless you think somehow that 150 basis point equity risk premium is somehow normal. This stock market, I know you said wait by get rid of 2022. This market is still really expensive, especially benchmarked against where interest rates are. The ERP is ridiculously low.
But that happened
Let me just continue. If you slap a 15 multiple, and let's take Michael Wilson, God bless Michael Wilson and Morgan Stanley. He's got it more right than wrong, okay? Despite the fact that he's a Wall Street guy. Where is he? He's on earnings for next year like 190, 195. You got to slap a 15 multiple on that. And that takes you down to like 2,900 on the S&P. I'll tell you, we get down to that level, and of course, credit spreads will not be where they are right now. We're going to have tremendous financial market tightening, and maybe that's also what they're waiting for, is more financial market tightening, because credit spreads, as we all know, spreads they're not reflecting a recession. So we get to these levels on spreads in the stock market. Policy is not going to be where it is right now. They'll recalibrate to a different setting. And so I don't know what the timing is. I mean, who really knows? I imagine that second half of the year, that's my guess right now. I think it's going to be a story for 2023. I think they'll be cutting. They're not cutting once, not cutting twice. It's just about the cycle. I don't really care about secular inflation, okay? Interest rates are cyclical, okay? And interest rates will move with or without the Fed, okay? We go into recession, and with the momentum in inflation going down, they'll be cutting rates. And you got to remember that to a T. It doesn't matter what the inflation is. Paul Volcker had double-digit inflation. The guy cut rates in the early 80s by 1,200 basis points. The greatest inflation dragon slayer of all time cut interest rates more than any other central banker in U.S. history, okay? So yeah, we're going back down to the zero bound. And I fully agree with Charles. And I think there's going to be, Powell's moved from like Bambi to Godzilla. I mean, it was 2 years ago. He was the nation's resident social worker. I mean, all these different unemployment rates. Danielle, you remember all these unemployment rates, the different demographic and the downtrodden and all this stuff. And he's just, but I really think that it's back. This is the real Powell, is the 2018 Powell. And I think that what he wants to do is break this unhealthy link, and it is an unhealthy link between the financial economy and the real economy. Not that there's always been a symbiotic relationship, but let's face it, it reached a feverish pitch, maybe 3-4 standard deviations, and I think that's what they're trying to break.
Yeah, so where I was going with that was that you talk about the multiple, we talk about spreads. We've seen a very meaningful rally at some point during the fourth quarter. I didn't feel it from December, but this was addressed in the press conference, right? Where the question was asked that you, Chairman Powell, keep talking about tighter conditions, and here the market flies in the face of what your objective is, right? We've seen rallying rates. We've seen equity markets go up, since that point in time. We've also seen credit spreads tightening meaningfully. So what is the disconnect here? Is the market just so predicated on this Fed put?
Oh, I think so. I think it's absolutely ingrained. I mean, absolutely ingrained. Otherwise, I don't think Jay Powell would be ignoring Dallas Fed staff papers that says that 90% of all the job openings are for poaching the employees of your best competitor and not meant to suck up slack in the labor market. I mean, he's ignoring Philadelphia Fed research on quicker ways to revise non-farm payroll. He's just ignoring it all. He's not stupid. He's a pragmatist. He's a lawyer. He can see both sides of every argument. So why is he ignoring his own staff's papers?
I don't know, Jim.
Yeah, let's put the Fed in the perspective here. There's three voices you need to listen to at the Fed, and I'll give you the weightings for them. 75% is Jay Powell. 24% is that other important Fed voice, Wall Street Journal reporter Nick Timiraos.
Yeah.
And 1% is the collective of everybody else.
Sure.
It is Jay Powell, benevolent dictator. He decides what he wants, and this is about him trying to extricate the Fed put from the market. And they're going to the point now where they've got core X services. That is a made-up statistic that the Fed invented out of whole cloth 2 months ago. Go to your data sources. It doesn't exist unless your data sources already reverse engineered it based on what the Fed said.
By the way, we've actually looked at it for a long time because we've always dug out the shelter component, so it's a piece of it, and it is one of those things that rarely goes negative. Rarely.
Yes, you're forecasting education and
no,
healthcare.
I got it.
Okay.
I get the point. Yeah.
And if it
although healthcare does seem to be on a downward trajectory.
Did go negative, if it did give them, if it gave them if they gave them an answer they didn't like. Janet Yellen, 7-8 years ago, I did labor market conditions index, another invented out of whole cloth statistic that the Fed had. Gave her 2 years later, it was giving them a statistic that they didn't like. They discontinued it, and they found another one. Is what they'll wind up doing. He wants the Fed put gone. He wants the markets to stop trading on liquidity. And the problem is that's exactly what they are trading on right now. Bad news is good news. Bad news, boy, I really hope that these companies miss and they fire employees and things get bad because the Fed will cut to zero and the market could go up. That's what everybody is hoping for. And that's the cycle that Jay Powell is trying to break. Now, the problem is, after 2020 into 21, he did more than anybody else to enable people to think about that cycle, to rethink that that's the way that the Fed is going to react. So he's trying to undo kind of his own damage. So when you look at where the Fed is going, yeah, we could talk about the economy. We could talk about the state of the economy. I don't think that's really what's at play here. I think what's at play here is him trying to break the Fed put. I also think that on another level, and I'll give him he is worried about, they're not stupid people. They're trying to do an honest thing. He is worried about elevated inflation. One quick statistic, 40% of the American public, 40, They don't have any assets. They don't own a home. They don't own a portfolio. They only get a paycheck. And if we've got negative real wages, they're buying stuff, whether it's at the grocery store, at the mall, they're buying less every month, every year than they did the previous year because they don't have a cushion to fall back on with look at what my house price did or look at what my portfolio did. They don't have any of that. He's correct to worry about negative real wage growth. Whether or not he's got the prescription for it is another issue. But I think overriding that is he is focused on breaking this Fed put.
I just think that they've crossed a Rubicon on that. I'm just not sure, considering where the Fed balance sheet was not long ago, you'd have asked anyone, can it be $2 trillion? Can it be $3 trillion? And not long ago, people would have laughed at you, said it's just structurally impossible. So, David, when you mentioned the Fed listening to the markets, 2018, 4 rate hikes, we're almost down 20%, right? So January 4th, 2019, Jay Powell, he's at this American Economic Association conference with Bernanke and Yellen, and he gives this speech that all of a sudden he says, we're going to take a patient approach. This is a Fed who's been pounding with a mallet. He's hiking rates a week before Christmas. He doesn't care. And we're going to listen very carefully to the markets. And that was the turn right there. That was Jay Powell 2.0. We're down about the same percentage last year as we were then. And I wonder where his risks, if the market is where he's getting his fill from, if they listen to the markets at some point, is he actually going to be, will the Fed actually be the blink because of the markets going too low?
But isn't it the opposite of what just happened?
Just remember that what happened in December 20. Okay, firstly, it wasn't down. We were down 20% in a year. We were down 20% in a month back in December 2018. Like it was vertical down, and the corporate bond market, the high yield market was closed. Deals were being pulled. There was nothing. There was no bid. That was a scary period. Okay, that was totally different. There was no bid in the corporate bond market, and plus, look, he was facing the Trump tweets all the time, and but now, this time around he doesn't. Biden has given him carte blanche because of course Biden got blamed for the inflation, we'll see what the political pressure is going to be going forward. But the question I would want to have, and I'd actually want to ask this of Jim Bianco. Do you believe that the Fed will be successful in eradicating the Fed put? Yes or no?
If Jay Powell gets his way, if it's, when you ask what the Fed's going to do, let me find out what's Jay Powell going to do. Because to answer your question first, there is a broad disagreement within the Fed. And we're at a rare point now where if you put that hawk-dove scale, who's the most dovish, who's the most hawkish, you might very well have the vice chairman, Lael Brainerd, near, if not the most dovish, and the chairman, Jay Powell, if he's not the most hawkish, he's very close to it. They're not somewhere in the middle anymore. They're at wide ends. But the chairman gets what the chairman wants. So if Jay Powell sticks to his guns and stays where he is, yes, he'll break the Fed put. You won't like what he'll have to do to do it, but he'll break it.
But hold on, the point I'm making is that, and that's when you're going to go back down to remember that they cut rates to a T, 500 basis points in a recession. And they got the funds rate up. Well, they're going to get it up to 5 plus. And then they're going to go, and look, it's just the cycle. They cut rates 500 basis points, irrespective of what your view is on inflation, Jim. In recessions, they always cut. Now, maybe this is, you're going to say it's a totally different Fed. What I'm saying is that once they break this link, because I'm in your camp, then rates are going to come down. And I think Jeff Gundlach is right. They're going to come down quite a lot. Now, not immediately, because it's never quite immediate. But once it starts, like I'm surprised the swaps market's just priced for 2 rate cuts. Now, the question is, you're saying, are we going to stop at 2? We're going to go through 2%. I agree. But 2 rate cuts, please. We had a couple of rate cuts in 1995, right? After that 94. There's going to be a lot more because that wasn't a recession. That was a soft landing. They cut rates 2 or 3 times in a soft landing. There ain't no soft landing. In a recession, they're cutting rates back down to 0. But the level of assets, not just equities, but residential real estate, are going to be, we will not be talking about inflation anymore. We're talking about deflation and asset deflation, which is already starting. So it's going to be, we'll be talking about different things. People can't see past the tip of their nose and see that, because everybody's extrapolating the last 18 months into the next 18 months.
I think the 2 rate cuts is basically, that's the happy talk that everybody thinks that the Fed, that somehow the Brainards of the world, the Mary Daly's, the San Francisco Fed heads of the world are basically going to take over and say, we've done too much. We got to back off a little bit. Let the stock market go to 5,000. That's what they're hoping for. But I agree with you that the day, if you look historically, what happens when the Fed starts cutting rates is a full-scale panic in the stock market because we're over the side and we're going into a bad recession. And these rate cuts maybe they will help, but not immediately. And it's usually the worst time to buy the stock market is right before the rate cuts come. But now the market has decided the best time to own the market is right before the rate cuts come. And I think they're going to wind up ruining that idea that, oh yeah, once the pivot happens, the market will take off. No, the pivot will happen because everything's falling apart. And that's why you're going to get the pivot. You're not going to get the pivot because 14 months of bad markets is enough. Now you can get some relief.
They're using 2018, 2019 as the template.
Right.
It worked so well. I mean, there was a very scary mine shaft bear market. High yield market was completely shut down, but that was a great buying opportunity. And so that's become the template. Rosie said that interest rates will move with or without the Fed. And that's absolutely true, but it's actually always true because the Fed simply follows the 2-year Treasury. I've been saying all year in my webcast, we should replace the Fed with the 2-year Treasury. And lo and behold, in the first part of 2022, the Fed was way behind the curve. The 2-year Treasury was going vertical. It was up at 1% and 1.5%, and the Fed raises rates 25 basis points. And next thing you know, they're doing 75s. So the Fed will follow the 2-year Treasury. And the 2-year Treasury is down roughly 40, 50 basis points from its peak. So we're already starting to get the message from the bond market. But the real question, I think, is I agree that Powell wants to eliminate this concept of the Fed put, but I'm more worried about the politicians. Because once the economy rolls over, what we've seen is massive relief free money spending, which I've been predicting for years and years and years. I used to say, I can get inflation up by 5 o'clock this afternoon. You announce that the Treasury Department is wiring every American $1 billion. If you don't get inflation by 5 o'clock, the lines at the Ferrari dealers are going to be something to behold. So we actually started doing that a long time ago with George W. Bush and a couple $100 so you could buy a tie in response to the global financial crisis. And then it was thousands of dollars. And that's the game plan. So when you have distress in the economy, I think Charles is onto something. You know, we thought that $700 billion was a big stimulus back in 2008. Now we're doing, trillions and trillions. Maybe the next time it's not $1,000 or $1,200 a month. Maybe it's $50,000 a month. And that's what I'm worried about when it comes down to sort of everything financial and societal.
It is a good way to get reelected.
It's work.
Hey, listen, politicians run on nominal numbers. So the president can say the GDP under my watch is up 25%. That goes a long way from a chicken in every pot. Right? We've come a long way from that. But
Jeff, the only thing I'll quibble with is that I think a GOP-led House of Representatives in 2023 is going to want their pound of flesh. So I think they're going to be very resolute in not bending to immediate stimulus.
What about the 1.7 trillion that just was voted on?
But it's pork. It's
Yeah,
not
that's
direct.
what I mean.
You're directly depositing it in people's accounts.
But the representative from Texas was all over it too when he was nominating yesterday, right? I mean, that's what he was focused on. Now, I'm not saying it was the exact thing.
But again, to Jeff's point, it's directly depositing cash into people's accounts. That's how you
Into
generate
politician
the
accounts, at
inflation.
least. Yeah.
They're always going to have
Right.
inflated earnings. But my concern is that in the immediate onset of recession, that the Republicans are not going to be willing to just write checks and directly deposit money into households' accounts. Maybe come 2024, they're like, oh God, there's a presidential election, people are suffering. But I think the pendulum, there's the political divide in this country, I think, can affect the economy because they're so extreme on one end or the other that they're going to say, we've been through the 2 years of hell under Nancy Pelosi, so we're going to take our revenge, despite what the economy is doing. I think that's a very interim risk.
To me, it's easier to talk about when you're not the party in power.
I'm not saying it's right, wrong, or anything. I'm just saying I think they want their pound of flesh.
I might have agreed with you more prior to this last election when, the results of the election were very different than what most people were predicting in terms of the lack of seats taken, just the paucity of seats that were really won in the House. And I happened to notice, Jim was talking about this before the roundtable started, they can't even elect a Speaker of the House.
Right.
So I'm not so sure the Republicans have their act together. So I'm not sure that they're going to be that much of a bulwark.
Yeah, I was actually talking to Danielle about this last night, that historically the Republicans have coalesced around each other, right? But the difference is it was the Democrats usually that had the extremism within their party. It was fractured, right? But you're seeing just the opposite right now with McConnell.
But to Danielle's
preventing it.
To Danielle's point, so McCarthy would have been a deal maker, and the hard right of the GOP don't want a deal maker. So they don't want a deal. There is no more fiscal stimulus.
Well, they just don't like
with all deference to the 1.7 trillion. It's not about that number. It's about what does it mean for growth, and the fiscal impulse is the grand total of 50 basis points. 2023. So we talk, 1.7 trillion, a giant elephant. What's the fiscal impulse on growth? It's about growth. 50 basis points. Well, the Fed is going to look after that in the next 2 meetings. Okay, the next 2 rate hikes is going to look after the fiscal stimulus, and we haven't even talked about all the lags from what they've already done in the next year. It's a pimple what you're talking about in terms of the fiscal largesse. And I don't know, in terms of your first comment about where's the vitality for the economy, I'm struggling with that. Profits recession, no capital spending. As Charles had said, the excess savings, most of it's already done. What's left is in the wrong hands. It's in the fat cats who aren't going to spend it. We have a cascading, all the lags from what the Fed's done is going to kick in. Unemployment is going to go up. Consumer 70% of GDP. Housing is really in a tailspin. The only thing that's left is municipal and state governments have a lot of cash. And so anything that's infrastructure related to state and local governments is probably going to be the one lone growth engine of the year this year. Not enough to prevent a recession.
Property tax bonanza.
Can I throw out a question then to the rest of the roundtable here?
Do you want to move over to the seat?
Yeah, sure. This is the most discounted recession ever. So a lot of the problems, where's the growth going to come from? We know this. It has already been priced into the market. Or has it been priced into the market?
And it's 17 multiple. I don't know. Plus, it's not even a 17 multiple. The analysts are still calling for 7% earnings growth for next year. The analysts have been trimming their numbers, dribs and drabs. Well, we never had a recession and earnings up 7%. And the consensus is 7%. That's what I mean, actually, is that the real multiple, the recession multiple, is 20. It's not 17. We'll do the math on that. I mean, as to what you want to own in fixed income against equities. No, it's actually, it's fashionable to say that it's the most widely, everybody's talking about the recession, but not everybody is on board, by the way. There's a lot of people that still think we're going to avoid a recession, but it's not fully priced in. Is a recession, do you think, you guys are the fixed income guys, do you think it's fully priced into corporate spreads?
We were talking about this.
Is it fully priced in? A 17 multiple.
There's been zero credit band, and that's a lagged indicator. But the one thing that could potentially be the difference in this cycle is that the amount of refinancing that took place in 20 and 21 was massive. And so you look at current coupon on the outstanding stack in sort of IG and high yield paper. Now, over time, that will change.
What about bank loans?
They're not, the bank loans are completely different. Notice I did not say that one, Jeffrey. And bank loans are a whole different beast, and they have a big problem, right? They have to reset because of the floating rate coupon. But if you look at that part of the market, potentially it's more of a lagged variable than typically in a cycle because you're not getting that push through in the marketplace because the Fed policy has not impacted corporate America much. Now, there's obviously people that need funding needs and everything that'll go on. But the bulk of it was refinanced at significantly lower coupon. The one thing that's what I would throw against that, though, not Treasury. We were financing very short, right? The cost of issuing the public debt is significantly higher.
And you have 80% of the mortgage universe outstanding with a 2 or 2.5% coupon. There's no refinancing. There's no proceeds for refinancing in 2023.
As of October, November, when rates were at their peak, 92% of the entire government guaranteed mortgage market was non-refinanceable, even if rates fell 200 basis points from me. Right. There's no refinance.
And that's why you get into this discussion. Do we have to absolutely go back to the zero bound to generate any economic growth? Because if you've got to get past that 2% coupon, you got to go back down to the zero bound.
1 year ago, the stock market, January 4th of 2022, was ridiculously overvalued by historical metrics. We had a list of about 30 different indicators, price to book, PE ratio, CAPE ratio, all this stuff. And they were mostly in the top percentile of overvaluation versus stock market's own valuation history going back decades. But the amazing thing was, as overvalued as the stock market was relative to its history, it was below average valuation versus the 10-year treasury. Bonds were that overvalued, substantially more overvalued than a wildly overvalued stock market. Not anymore. You know, the stock market is less overvalued, but as Rosie has pointed out exactly correctly, it's not cheap, not particularly not against this backdrop, and yet rates have gone up. I mean, let's put it this way. 18 months ago, to get 5% yield out of the bond market, you had to leverage junk bonds 50% and hope for no defaults because the yields were in a 3 handle. As of a couple of months ago, you could get 10s, 12s, 14s out of bonds. And I'm not talking about the junkiest stuff even, because spreads had widened and rates had gone up. So we're at such a different valuation point now than where we were a year ago. And I think that's really important when people think about asset allocation.
Yeah, and I want to save that for our next section. But before we do, the one last thing that I want to bring up on the macro environment is thinking about the rest of the world. We've been so myopic here on the US, and we know the ECB has been massively behind the path of the Fed, and the Fed's led us both directions, cutting as well as hiking. And so as we see the inflation problems there, again, I don't know how monetary policy fixes it, but we know that they're going to continue to press. The forecasts are there. What does this spell for the global economy?
So I think that you're bringing up the most underappreciated aspect is that there's more of the world in recession right now than there was in 08, 09. And this is kind of an extraordinary moment. And you have, as Jim pointed out, you have really high energy costs. The Bank of England is in a pickle. The ECB is in a pickle. I mean, they need to get their overnight rate above inflation. That's harder to do unless summer sets in immediately. So, and China is not this is not the China of 08, 09. This is not the industrial recession of 15, 16 that China bails out. China's got its own domestic problems right now. It announced today that it was going to stop investing in the semiconductor industry so that it could address the healthcare crisis. I get it, that the rip the Band-Aid off is going to, but even after that, you're not seeing an impulse in the property sector that would suggest some massive commodity super cycle is in the making and that China's going to come in and rescue the world economy in the second half of 2023. The evidence is just not there yet.
The United States, obviously, we all know that the yield curve is inverted and it's always inverts. It has sort of before recession, it has that sort of a look right now. But one thing that hasn't gotten much attention is there's such an indicator as the global yield curve, and it's inverted for the first time ever. So that rather strongly suggests that this isn't simply a U.S. phenomenon.
And if you look at China, just riffing on something that Danielle just said, they're in the process of reopening, and they picked probably the messiest, most chaotic way to do it, but they're in the process of reopening. And Wall Street has an expectation of, oh good, that means we're going to go back to 2019. That means everybody's going to go back to work 14 hours a day making iPhones, and the world will just continue as it used to be. But what we learned in the West when we reopened, and what you learn about every pandemic, is coming out of it, we're not the same as we were going into it. The big headline thing that we've seen in the West is the end of the 5-day work week for service sector office employees. And I don't think we're going to go back to it. And, others can disagree, but nevertheless, it's been 3 years and we're not going to go back to it. China is going to reopen. I don't know where they're going to go, but they're not going back to 2019. They're not going to get 40 million people riding the subway, which is what they used to have in the major cities a day, going to 12-hour shifts, manufacturing stuff to ship to the West. Right now, their subway ridership is less than half of what it used to be pre-pandemic. They're going to do something different, and we'll find out what they're going to do. And the assumption that we have going into 23 is big demand for industrials and raw materials, especially energy. China sucks up all the raw materials. Out the other side is going to come a huge boom of finished goods. It's going to depress goods inflation so the Fed can pivot and the stock market can take off. I think it all stops with the China story. And they're going to get out of their house and live their life again after 3 years of lockdown. But I don't think they're going to return to 2019 any more than we did in the West.
So does the BOJ look like the smart one through all of this too? That they've been sitting on the sidelines. Obviously, they've wrecked the value of the yen relative to the dollar, but with their whole yield curve control, obviously they've, you lessen it. You saw what happened. The market reacts very viscerally. But are they right for this? Because the way it sounds like it, the Fed's going to have to pivot. The ECB can't push too far, even though they want to. Maybe Japan just doing nothing. It's like hiking for the sake of cutting, right?
Japan is, just a quick comment about Japan. They don't have yield curve control. They have 3 bond control. They basically, they target the 10-year, the old 10-year, and the old 10-year. And if you look at their yield curve, it kind of goes up like this. And then you got these 3 issues that are down at 48 basis points because that's where the target is. And the 9-year and the 11-year, just kind of break without it. So it's obvious that, and if you look at their swaps market, which is not subject to yield curve control, the 10-year swap is trading at about 85 basis points. So it is telling you that market is straining to go higher, and the BOJ is trying everything it can to hold that market down. It is a highly distorted market, and they've got a problem now. And their problem is they own half their market. They own 50% of the JGB market, and it's highly liquid. And if they were to let rates go up, they're going to be at a terrible position in terms of fiscally, interest costs. Everybody keeps worrying about interest costs in the US because of interest rates are going up. Worry about it in Japan. Japan is going to be way bigger and way faster problem if rates go up there than you would have us straining because of it. So Japan, are they the smart ones? Only if you say that if I could just continue a mistake long enough to make it to the next cycle. And that might be what they might be close to doing. But boy, they've been offsides for so long that maybe the circle has come all the way around.
And now they're running a deficit, right?
Yeah.
So that's a whole different dynamic in Japan. They're
They're
not
smart
they're
as a
no longer
guy.
running a current account surplus.
They're as smart as a guy jumping out of an 80-story window. 70 stories down says, so far, so good.
I'll be the lone defender of the Bank of Japan because I would say they're the only central bank that didn't panic. And I think that in the overall annals of economic history, this will have proven to have been transitory. Okay?
This being what?
The inflation.
Okay.
The inflation was a supply shock. In the US, it was compounded briefly by the massive fiscal stimulus. Then again, look, there was a point we thought this was the Black Plague. Okay, we didn't know. Who knew the vaccines were going to come as quickly as they did? We were told it was going to take 5 years to get a vaccine, and policy mistakes were made. But in a historical context, it was transitory. The Fed just never explained. I guess the Fed thought transitory was a couple of months. They never explained because it has no definition really in terms of length of time. This was transitory. And I'll tell you something else. The last time that we had a dual shock of this magnitude globally was a century ago with World War I. We had a world war. That was followed by the Spanish flu. This time around, we had a global health shock compounded by the first shooting war in Europe in 80 years. And that was 4 years of 15% inflation. Interesting enough, when F. Scott Fitzgerald wrote The Great Gatsby in 1925, there is no mention of the Great Inflation. Okay, and then we went through a decade. Once these supply pressures subsided, as they are right now, we went through a decade of no inflation. By the way, with very vibrant and youthful demographics in the United States. A decade of no inflation, 10 years. And of course, we had the deflation in 1929 into the 30s. People think that they know we're going to settle into 3-4% inflation. How does anybody really know that? But we have a template, sample size of 1, what happened a century ago. I think the Bank of Japan actually got it right. So I'm going to tip my hat. And in terms of the comment about, okay, we're not talking about global. Well, the reality is that because the U.S. still drives the bus. We're all U.S.-centric because the U.S. matters. And I lived this in real time when I was at Merrill back in 06 and 07 when the theme from my compatriots on the global economics team was global decoupling. The U.S. went into recession first in December of 07. The U.S. went into recession before Bear Stearns, 3 months before, and a year before Lehman and AIG. And so the view was that global decoupling, there's no global decoupling. There's no global decoupling. And so all these other parts of the world have their own particular challenges, and China's in a secular growth slowdown, make no mistake. but a US recession is going to bite hard globally. And it hasn't even happened yet. It's just about to.
Yeah, I think that's a great soundbite to end this first section on, because we want to talk about markets and we really need to dedicate the time. So I want to encourage everyone to tune in to the next episode that we'll be launching here, and we'll be talking with the panel about their outlook on markets in 2023.